Based off your comments and your questions, we're going to be diving down into a variety of dividend stocks today, primarily the most interesting of the bunch. We're going to talk about Intel, which has been a popular comment that comes up in my comment section. We're going to be talking about a little bit of the gold companies and talk about the things I like that I hate, because some of them are just blowing up right now because they've been trading at cyclical lows, even though gold's exploding. And then we're going to talk about some of these covered call ETFs, because we're looking for those crazy high yields. If you're looking anywhere from 7, 8 to 12%, that's the place a lot of you guys are running to. I'm going to offer some comments, just opinions that I have surrounding those ETFs, as we're going to look at two of them on the US side of the border, one on the Canadian side of the border. And if that is something you appreciate, just hit that like button, folks. Let's get right into this. First and foremost, Intel, baby. A stock that I've never bought, but honestly, I really like it from a valuation standpoint over something like Nvidia, because it hasn't been able to keep up with the growth rate Nvidia has had, just because management's doing a lot of shifting around. But from a financial standpoint, I really don't know how you go wrong here. Let's talk about that, because recently Intel has been trading massively off its highs, about 33%. Historically, though, it's been typically up and to the right. But like I mentioned before, guys, there's no guarantee that stocks go up, because if you told somebody back in the dot-com bubble that Intel wouldn't be pushing its highs, even though its revenue would have exploded over the last 20 years, a lot of people have a hard time believing you. But if you're looking for dividends, let's talk about that, because this is paying a 3.23% starting yield right now with a 9 PE, which is insane. And a lot of the downward pressure right now is being driven by the fact that Intel delays the 2023 server chip, says it needs to boost spending to catch competitors. Intel said on Thursday that it would have to spend heavily in the next 2 years to power its turnaround and transformation into a manufacturer, which I think is a good standpoint from an investing standpoint, right? Because you want something that is going to grow into the future. And I think they're kind of laying the groundwork for what could be huge potential. It just wasn't the best news to see that they're pushing back that major chip production and that new chip to 2023, 2024. So a lot of their customers maybe not as happy about that. But talking about it from the financial standpoint, first, let's start with the dividend standpoint. I mean, take a look at the growth on this thing, man. I mean, we go back to 2012, so a 10-year history, from 21 cents a quarter to today at 36 cents a quarter. And honestly, from a payout ratio, guys, let's just talk about that real quick, because their payout ratio is only 28.6%. This thing has been a dividend growth beast. And if you're looking for that sustainable cash flow and trying to get long-term growth from the payouts, I don't think you're going to go wrong here, guys. The forward PE is going up a little bit, probably related to that cash spending. But let's just take a look at the financials, because like I said, guys, from a revenue growth standpoint, this thing has been steady and up to the right. So their underlying business seems to be very, very strong. From a free cash flow standpoint, positive pretty much every single year. So long as they're continuing to sustain that free cash flow, I don't think there's going to be too many problems. It's going to give them that capital to reinvest into those the chip manufacturing, and along with paying out that yield, right? So that's Intel. So let's talk about Barrick real quick. Okay, gold. I know 180 shift here, but when you got people like me, Kevin, buying gold, I mean, it's something we're going to want to pay attention to. I've talked about this before. Top 50 gold miners are producing record revenue, yet their stocks are trading down drastically. I thought about making a trade, short-term trade out of this, because gold, oil, all of those stocks are relatively cyclical. They have booming years, and then they have slowdown years. The stocks don't really go up. They don't really go down. They just get stuck in these endless year trend cycles, right? And that is what Barrick looks like it's about to go through, because on its last earnings, guys, oh my God, did it jump up 25% within a couple days here. Dividend yield starting not nearly as attractive, 1.71%. PE is a little bit higher, but let's talk about this real quick, because the gold market is going to be a fascinating one this year, considering historically every time the Fed raises interest rates, which, let's be real, over the last 20 years hasn't been a whole lot, but every time they have, gold has spiked on it. And Barrick stock climbed 20%, basically announcing $1 billion in share buybacks, and they increased the dividend, right? Now, personally, from a dividend standpoint, I don't trust them because they're too cyclical, right? If we go back and just look at the last, almost 10 years, guys, from 48 cents to 64 cents to 98 cents to 0.07 cents to 9 cents today, and now back up to 0.157 with another dividend increase. There's just no stability in getting cash flow out of these guys. And I'm not typically the biggest fan of the gold miners, but this could be a huge value setup, in my humble opinion, for those of you that are interested. I would perhaps use this as a swing trade, use it as a parking place for capital against hedging your tech stocks, because I've been thinking about it myself, guys. I mean, in the next 6 to 12 months, those things could be doing much better, especially considering gold keeps going up, and they're already insanely profitable at 1,800 an ounce, let alone if this stuff pushes past 2,000 an ounce. Now, let's talk about covered calls, baby. These are the most fascinating conversations, because a lot of people write their own covered calls, but if you don't want to do that, if you're not comfortable doing it, these ETFs can really take advantage for you. Now, don't expect growth out of these guys. I'm honestly surprised over the history. XYLD is actually trading up, but again, if we go back, this is like like a 10-year cycle here. We're not really talking about a whole lot of a gain. Now, this thing does follow the market. A lot of people thought they were heavily protected against the market if the market tanked with covered call ETFs, but you're not. You're going to get hit just the same, and dare I say even harder. Let me explain why. First and foremost, guys, this thing starts out at an 8.5% yield. Obviously, the expense ratio is a little higher compared to a regular ETF at 0.6%, so you're getting almost an 8% yield, solid, presuming things stay fundamentally the same, and this is coming off those top 10 companies, basically. 30% of these holdings they're writing covered calls against are all the S&P top 10 companies, so no real complaints there, but where I get a little concerned is in the dividend payout. A lot of people use these covered call ETFs for short-term parking capital, and honestly, if I was going to play these, and I'm thinking about playing them, I want the markets to tank, and I will tell you why in a sec, but let's look at the dividend history here, because it is not nearly as stable as people think. Obviously, the March 2020 crash, guys, unfortunately, XYLD here actually stopped the dividend payout for what looks like a little period of time, and then as the market stabilized and started going back up and has consistently gone up, we can see that the payouts have really stabilized and actually increased drastically. The more stable the markets are, the better writing covered calls is going to be here. And yeah, let's talk about RYLD, another one, guys. RYLD, similar performance here from the stock price, also dipping down slightly on the market sell-off. This one is against the Russell 2000, however. Same expense ratio, much higher payout at 11.6%, so you're walking away with a clean 11% if things remain stable. And again, this is purely just writing covered calls against the index rather than the individual holdings. But again, we look at the stability of the payout ratio, guys, and for some reason this 10-year chart doesn't go back 10 years, but if I scroll down, it'll show me the 10 years. And we can see how unstable these dividends were paid out going into the March crash here. I mean, it went from 23 cents to 0.15 cents a month, and then it kind of rebounded as the market rebounded. So, I mean, we just hit an all-time high payout for RYLD, but let me tell you, on the US side of the border, before we look at the Canadian covered call ETF, I would just wait for the crash, guys, because when this thing crashes, the payout's going to drop. You're going to see, obviously, a lot more instability in a lot of what's going on here. There's no guarantee the market crashes, obviously, but that's when you get the real value out of these covered call ETFs, because typically after we see a floor in the bottom of the market and the rebounds start to happen or stabilization, that's when you really start to cake in capital. Because could you imagine buying XYLD anywhere at the bottoms of this market for the first 6 or several months? I mean, not only would you be up on the stock price, but the dividend yield would have went up massively over the same time period. So I don't want to buy the top here per se, but I would look at this as something to catch on the dips. Now let's look at the Canadian side with something like the BMO Canadian High Dividend Covered Call ETF, trading on the ticker symbol ZWC, something you guys have recommended to me, and more stable than the US market because the Canadian markets are voting to be the only thing in the green for me right now anyways. And taking a look at this guy, way higher expense ratio, 0.65, 0.72. Okay, maybe not that much higher, but we're still looking at about 10 points. And that really brings down this 6.15% yield closer to about what, maybe a 5.6, 5.7%. So, I mean, the 5% isn't nearly as appealing as getting, you know, an 8 to 12%. But let's just take a look, because this is writing covered calls against stocks that I already love. So this is really confusing to me, because we're looking at things like Bank of Nova Scotia, Toronto Dominion Bank, Bell, Royal Bank. Some of these are the top 10 largest companies in Canada, Enbridge, Canadian National Railway, Manulife, TELUS. The thing that I have a big problem with this is the dividend payout, guys, isn't really that great, considering most of the companies in here already pay close to those high yields. I mean, Bell's almost at 6%, I think, right now. Enbridge is at 6%. I mean, TELUS, when I was buying, was at 5%. So it's just like, why take the instability and the lack of growth from a covered call ETF when you could just own the stocks individually, right? And when we take a look at the payout, guys, again, not stable. There's nothing stable about covered calls in volatile markets. So if I was inclined to buy these, which I'm very intrigued by them, don't get me wrong, they could inevitably make their way in my portfolio. It's just a matter of playing them when it makes sense to play them, right? Because if you can just buy Bell, you know, if you could just buy Enbridge, if you could just buy TELUS and get close to that 5% yield when they dip, not only are you getting dividend increasers, but you're getting capital growth on top of it, because most of those companies over the same time period are up a lot more than this guy. I mean, this guy hasn't done anything since 2018. And if I plug TELUS in here, guys, as an example, and I love TELUS stock, been buying a lot of it as of recently. I mean, again, the yield when you were buying it back, when I was buying it, much better, because I think I've averaged closer to a 4.5%, 5%. But still, look at that. Over the same 5-year period, almost a 50% capital growth. The dividend back there would have been drastically higher with those increases. So from that side of it, guys, I'd be a little more cautious for covered calls on the Canadian side of the border. But at this point, I want to pass the question off to you. These are some of your comments and questions, and offering some insights into dividend stocks that interest you. Now, these are just my opinions. You do not have to agree with them. So I want to know what you think about about Intel, about gold stocks, generally just about these covered call ETFs. I'd love to hear about it. So stay cool, stay awesome, and as always, I look forward to catching you in the next one.